Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, this is James Kandasamy. Thank you for listening to this podcast. I appreciate you. I know I provide a lot of value through this podcast, and I want you to share it with your friends, with your families, and anybody else that you know that kind of benefit from listening to this kind of content. Go and share it through Facebook, through LinkedIn, through Twitter, through Instagram, or any other channels that you want to share it, because sharing is caring. Thank you. Let's go on with the show.
Hi, audience and listeners. This is James Kandasamy from Achieve Wealth through Value-Add Real Estate Investing Podcasts. Today, I have Mauricio Rauld, who's one of the most well-known syndication attorney, and he's based out of California. His company is Premier Law Group. He focuses a lot primarily on syndication. So it's going to be a very interesting discussion here because I want to talk about how a passive investor need to be aware on what happens in the syndication world, right? Especially passive is 95% of the number of people in terms of the syndication. So I think it's very important that we cover a good segment of this podcast for passive. Hey, Mauricio, welcome to the show.
Thanks for having me, James. Looking forward to this.
Awesome. So, as I was telling you before the show, I usually bring in operators. I think you are maybe the second one after, maybe cost segregation discussion, who are more like service providers for our industry. Excited to have you here. So let's talk about passive investor, right? Because passive investors are new to this business and, they are getting bombarded with deals. And some passive investors, of course, never seen a deal. They only know a few sponsors, which is okay, right? It's all about trust and respect and knowing the person and liking the person and all that. But tell me about how would you define at very high level who's a passive investor?
Well, a passive investor is the one that essentially writes the check and doesn't participate in the deal at all. So once they get involved, they are turning over the responsibility to actually run the deal to the sponsor. So it's really the capital. You think of the capital stack, you've got the equity and you've got the debt. The debt usually is from a bank or some kind of lender that's giving you most of the capital that you need, but you need that down payment, you need that capital expenditure, whatever your strategy is. And so you probably need about 30%, 35% of the purchase price in actual equity. And most people don't have that kind of money, or they want to share the wealth and they want to bring in other people to participate in the amazing, the amazing asset classes that syndicators put together. And so they are the equity, and they'll usually represent the vast majority of the equity. A lot of the sponsors will put in their own money, but it's usually a small percentage of it. So probably 90% plus of the actual equity that gets put into these deals is put in by passive investors. And as a passive, you really are giving up control. So your control really happens at the investment time. You're analyzing the deals, you're vetting the sponsors, but once you make that decision to invest, sign the documentations and send in your check, that's it. You're pretty much passive and you're not really involved in making decisions or really don't have any say in the deal. It's very similar to you're buying a stock, you're buying Apple or Amazon. You're not participating in the decisions of Amazon. You're just an investor. You own the stock. The difference, of course, being these are not usually very liquid and it's hard to get in and out. But yeah, that's what the passives does. They represent the equity and hand over the control to the sponsors, who's typically has the experience.
Got it. So, I know you represent a lot of sponsors, but I'm sure a lot of sponsors and you and sponsors talk about passive investors, how you want to represent the legal document, legal representation as well. So, can you talk about what are the things a passive investor need to look for in a sponsor or whatever their offering is, I guess, right? So.
Yeah, look, I think I always say this, hands down, the most important thing the first thing the passive investor needs to look at is the sponsor team. Who is the person or the team that's going to execute on this plan? Because you can have the greatest deal of all time. If you don't have a really good operator or good sponsor that's putting this together, it's not going to go well. I'd much rather have an average deal with a really good sponsor than a really good deal with a crappy sponsor, because a crappy sponsor is it's going to go downhill. So I think, the number one job of a passive investor first and foremost is to do their due diligence and vet the sponsor and their team, making sure they have the experience in whatever particular asset class they're doing, or at least somebody on the team does, making sure that they have a good track record, making sure they have a good team, good processes and good procedures, making sure that they have a record of keeping the investors, appraised and, updated on how things going. But there's no substitute. Anybody can put together a fancy business plan and a pro forma and how things are going to be great. But at the end of the day, somebody has to actually execute on that plan. Somebody has to manage that asset once it's purchased and move that business plan along. And that has to be a really well-seasoned sponsor to pull that off. So hands down, that's got to be the number one thing you've got to look at as a passive investor.
Got it. Yeah, the experience, the track record, all that. Yeah, I've seen people who say, I don't like that deal because the returns are not so good as you go on. I mean, returns are everything in an Excel spreadsheet, and you can just quickly change some formula and the returns can change. It's all pro forma, right? It's what's projection, right? The track record is very important. So have you had passives where, maybe or maybe sponsors who have said that there are some passives who are not happy in some deals before even the closing itself, when they're presenting the deal, or have you had that kind of discussion with sponsors, or how would you look for in terms of passive perspective when you're designing a certain business plan for some sponsors?
Yeah, one thing you've got to remember as a passive investor is unless you're coming in with a vast majority or a big chunk of the equity, these are typically take it or leave it type deals, right? So the sponsor will put together the package. They'll come up with whatever strategy they're coming up with. They're coming up with the percentages, the distributions, the allocations, all that stuff. And your job as a passive investor is generally to say, yes, I'm in, or no, I'm out. It's very rare that you're going to be negotiating terms because, first of all, you can't negotiate one-on-one terms. So whatever the terms are has to be the same for everyone. Or if you may have different classes, and so maybe different groups may have different. But I can't cut a special deal with one particular passive investor just because they thought they wanted to have a little bit more control of something, or maybe they wanted a different preferred return or something different. You can't do that. So that's why you've got to do all your underwriting and your analysis of the deal ahead of time. But you're not going to be negotiating. So if you're not happy with the deal, that's fine. You just say no in a nice way and move on to the next deal. But you're not going to be changing the deal. Now, if you're a huge investor, let's say you're trying to raise, maybe they need, making this up, but if you need $3 million of equity and somebody's coming in with $1 million or $2 million, then maybe you have some negotiating power to try and dictate some of the terms. But then the sponsor is going to have to go back and change all the documentation and make sure everybody else understands how the deal changed. So that's something that you got to keep in mind as a passive investor. When you're looking at these docs. One of the things you've got to be really careful about too, in general, James, is understanding what the requirements are that the sponsor needs to give you. So typically, most people rely. Nobody registers their syndications with the SEC, which is fine. Most people rely on exemptions. But the vast majority of the exemptions that they use require a really detailed level of disclosure documentation. Some of those red flags pop up every so often. If you get a syndicator that's coming to you as a passive investor and shows you the flashy brochure and all the great returns, but they don't have the disclosure documents. And by disclosure documents, I'm talking like a private placement memorandum, like a PPM. Certainly, if you're a non-accredited investor, or if there's any non-accredited investors in your deal, a PPM is going to be required. And that's the document that basically lays out all the ways the deal can go wrong. It just has all the disclosures, the good, the bad, the ugly, all the information about the sponsor. And a lot of times, especially if they're first-time syndicators or just kind of not on the up and up, they may try and cut corners and not give you that documentation. And I think that's a red flag. In the past, James, I don't do it anymore, but I used to review a lot of PPMs for passive investors. And every so often, I would look at the documents and I would say, well, this is clearly inadequate. There's no PPM. There's really barely any information. And those are red flags in the deal. And sure enough, you fast forward a couple of years and the two specific deals, right, was pretty obvious that there was no documentation. Those deals went south. I mean, there was some fraudulent activity going on. If somebody tries to convince you that you don't need certain documentation, always make sure you're talking to probably a lawyer or something to let you know that, yes, there are certain documentations that are required. I know you, James, usually, I think you do 506Bs quite a bit. And so you should be looking for that PPM, that private placement memorandum. You should be looking for an operating agreement that kind of outlines all the procedures that are involved in the entity itself, the voting rights and all that stuff, and a subscription agreement. Those are really the three main ones. And then you'll probably get a questionnaire as well. But the PPM is absolutely critical, especially if there's non-accredited investors. And just as a reminder, non-accredited means investors that do not have $1 million in net worth, excluding their primary residence, or earn basically less than $200,000. It's less than $200,000 the last 2 years. And I guess the reason, like I'm doing on the negative, the $200,000 the last couple of years with a reasonable expectation, I guess, of not earning $200,000 this year would make you a non-accredited investor.
Got it. Or you need to have more than $1 million in net worth, right?
In net worth, yeah. If you've got $1 million in net worth, excluding your primary residence, then you're, and that's probably the last change, if I remember correctly, that they made to that definition, which was made back in the late 2000s. And the reason was that, everybody, especially here in California, everybody was becoming accredited because the prices of their homes were going through the roof. So
really?
His mother was an accredited investor. And so they added that little provision to eliminate the primary residence and counting your net worth. But so if you are non-accredited, or you that there's somebody in the deal that's non-accredited, you should expect and demand a private placement memorandum, because that's the document that discloses everything. Like as a passive investor, your job is to look at the deal and make an intelligent decision. You kind of evaluate the risks and the merits, and you weigh those options, and then you make an intelligent decision whether to invest or not. You can't make an intelligent decision if you don't have all the risks and all the facts. And so you want to make sure you have that document that outlines everything, so you can make that intelligent decision of whether to invest or not.
Got it. Can you give our audience I know you talk about legal documents, PPM, company agreement, subscription, and questionnaire. What are the top 3 things that they want to look at, to protect their interests as a passive investor?
I think, let's see, probably the most important part is obviously you want to look at the allocations and the distributions, right? And you want to make sure the documents are matching. You want to make sure that if there's, if they're representing to you that they're going to give you maybe some preferred return, maybe they're going to give you as an investor a 7 or 8% preferred. And then on top of that, they'll give you 80% of the profits, and the sponsor will keep the other 20. You want to make sure that's in the documents, right? Just because it's in the brochure or the business plan, you want to make sure, most importantly, you want to make sure it's in the operating agreement. So a lot of times you'll see discrepancies between the PPM, which is just the disclosure documents, where they may tell you we're giving you an 8% preferred, but if that language is not in the operating agreement is really the document that dictates how everything is allocated and distributed in terms of return. So that's probably one thing, is just to make sure that everything matches up. I think exit strategy is something you want to pay attention to. How liquid is your investment? I mean, if you want to get out in 2 years, can you get out? Is this a 5-year deal? Is this a 10-year deal? Because you want to make sure you're matching your personal needs, what I call it, the personal investment philosophy, with the deal. I mean, if you're 80 years old and you're going to need the money in the next 2 or 3 years, going into a deal that's 10 years long is not something you probably want to do. So you want to be asking those questions of, when do I get out? What's my exit? If I need the money, before that, can I get out? Because I think that's kind of a really important thing. Voting is important too, although to be honest with you, these are, again, you're a passive investor, so most documents will reflect that you have almost no voting rights. A lot of them have no voting rights. I like to include, obviously if the sponsor's doing something nefarious and, commingling funds or committing fraud, you want to have some provision in there that will allow you to go in there and make a vote to remove the manager. And certainly you wouldn't want the manager to be able to just at their will, change the preferred return or change the allocations, right? You want to have something in there that protects you there. But in general, you're not going to have any say on when the property gets sold. Does it get refinanced? Do you want to raise the prices of the rents? Do you want to do this? Do you want to do that? You're going to have no say on that.
Oh, interesting. In my company agreement, I give all kind of voting rights. I mean, of course, it's 2/3 simple majority, but I mean, we do on the major decisions like sales or refinance, we do give. But I do understand a lot of people don't give that, or maybe they do, but I think mostly don't, I guess.
In the old days, they would do a lot of people use a limited partnership as the structure. So you'd have a general partner, a limited partner, and the general partner would have all the voting rights. So as a limited partner, you would have 0. But I find, like I said, if you commit fraud or there's at least some things that you do, you're going to want the right to be able to remove the manager, because it does happen. You do have people who are fraudulent and they steal your money. You want to be able to have a mechanism in there to remove.
Not only fraudulent, sometimes there are some incompetent managers, right? So sometimes life happens. maybe something happened in that person's life and he can't focus on the property right now. I mean,
I had a client who that happened. Their partner just started to, I think he had some kind of cancer, but his health just deteriorated to the point where he could not perform his duties. And luckily, there was two of them. But if he was the only sponsor or manager, then the investment's going to be suffering because he just can't. He's got bigger problems, which is his health, and so you want to have that option to replace the manager if that happens.
Yeah. So voting rights, what about in terms of the information that passive investors need to disclose to the sponsor? Is there anything that they need to disclose apart from whatever the documents that they are signing in?
Yeah, one of the documents you will receive is this questionnaire. And the reason you get the questionnaire, in addition to just kind of get basic information, your social security number, or your address and all that stuff, which is usually for tax purposes or for voting purposes and notice purposes, it's important for the sponsor to understand your level of sophistication. Sometimes you're required to be accredited in a particular deal, accredited investors we discussed before, or sometimes there's a limit to how many non-accredited investors you can have in a deal. So the sponsor has to keep track of all, how many accredited, how many non-accredited, and all of them have to be sophisticated. So those are the representations that the passive investor will make to the sponsors, like, yes, I am accredited, or no, I'm not accredited, but I am sophisticated, and these all have different definitions. And then in certain instances, in certain exemptions, specifically I'm thinking of a 506C, then the sponsor has additional requirements to verify that you are accredited. So they have to ask for your tax returns, they have to ask for your bank statements or brokerage statements, or maybe a letter from the CPAs, verifying that you're accredited. So there are things that you are required to provide the sponsor, number one, just for IRS and voting purposes, but also really your eligibility to become a member of this deal.
Got it. Is there anything else that passive investors need to know from what you're thinking in terms of investing in syndication?
Yeah, again, I think it really, there's so many different deals. I would start back, and I learned this many, many years ago from one of my great mentors, clients, friends, Robert Helms over at the Real Estate Guys. And he always talks about the number one thing is to have the first thing you start with is what's your personal investment philosophy? And it all starts with that. And so if you're like I mentioned kind of a little bit about, if you're 80 years old, you're not looking for, home runs. You're looking for capital preservation. You may need some cash flow. But even more than that, I mean, what asset class are you interested in? Are you interested in multifamily? Are you interested in mobile homes? Are you interested in single family? What markets are you interested in? What's your risk tolerance? Like all these things are things that you probably as a passive investor should know or think about ahead of time, so that when you do get a deal presented to you, just make sure that it fits what your general criteria and your personal investment philosophy is. And then once you do find a deal that fits it, then again, you want to, as a passive investor, really be digging into and really, which is one of the nice things about syndication, is you can establish a relationship with the sponsor. Unlike, when you buy Amazon, you're not talking to Jeff Bezos. You're not in a relationship with Bill Gates in the old days or Tim Cook. But with James, you can actually have a relationship with James. And
I know.
You can talk to him on the phone, and you can find out what his philosophies are and what's important to him in terms of an investment, what he looks for. And that's what I would encourage everyone to do, is take that opportunity to talk to you or the team or whoever the sponsors are, so you feel comfortable that your interests are aligned. What you're trying to get out of the investment matches what the sponsors are trying to do with the investments.
Got it. Awesome, Mauricio. Thanks for coming into the show. This wraps up our passive investor segment. Next will be active investors segment.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.